I'll hit the record button. There it is. Okay, welcome everyone. We'll start out with the agenda approval and any announcements. Staff or board, any need to change the order of the agenda?
No change to the agenda from staff. One quick announcement though.
Sure.
If that's okay. I just wanted to let board members know that we will be welcoming a new deputy treasurer soon. So we have Gavin Boyles has departed the office, and we're really excited for November 3rd to welcome David Scher to the office as deputy treasurer. Many of you may know him from prior stints at the Attorney General's office. He was general counsel of the Cannabis Control Board at its inception, and for the last 3 years, he's been the state director for Congresswoman Becca Balint. So brings a lot of experience here in Vermont with our federal partners, and we're really excited to have him on board. So just wanted to let you know of that change here in the office.
Great. Any other announcements from folks? If not, I will entertain a motion to approve the agenda. And I see John, seconded by Kim. All in favor, please say aye.
Aye.
Aye. Next item is approval of the minutes of the September 15th, 2025 meeting. Hopefully you've had a chance to review those. Would anyone like to make a motion? Will, with what I assume is a motion to approve, a second by Kim. Any discussion on that? All right, seeing none, all those in favor, please say aye.
Aye.
Aye. That passes. I don't see anybody from the public on Teams. Bill, nobody in the room there with you?
No one in person here, Mr. Chair.
Perfect. Then I will turn it over to, I don't know if it's going to be Tim or Eric on the two VPEC pieces.
Mr. Chair, if I could just take the first one very briefly. VPIC has a requirement every year to share their attendance report with the 3 retirement boards. And so we included it in your materials. There's no action needed on it. We just put it as an item to memorialize the fact that they have complied with that requirement.
And gold star for Kim.
I'll turn it over to Eric now for the meat of the presentation.
Thanks, Tim. Thanks, Mr. Chair. Can everybody hear me okay?
Yes.
Well, I really appreciate the opportunity to speak with you all a couple of times a year. It's very helpful to us at VPIC to understand what you folks are facing and what you're up to. And we hope that it's helpful for you all to hear from us what we're doing and how we're thinking about things, especially within the investment program. I do have a deck, if I can share my screen here quickly. I won't dwell on every page. Can everybody see this?
Yeah, the memo.
So starting with our budget, we've since we're an independent commission now, we've committed to sharing our budget requests with all 3 pension boards. Before we submit them, we want you all to understand how we're thinking about funding the operation and the cost of doing so. This year's budget, under the governor's guidance, they've requested no more than a 3% increase, and we're right at 3%, 3.1 maybe. Total cost of 4 basis points of our assets under management. This is very low compared to our peers. We run a pretty lean organization. There are only 4 of us on the team, including our new investment accountant, Georgia Reese, and we oversee over $6 billion in assets for the 3 pension plans, as well as the PAAA sleeve of assets. We do also envision bringing on oversight of the OPEB assets for the state employee post-retirement healthcare plan and the teachers post-retirement healthcare plan, and we'll be talking more about that as we go through the legislative session this year. But you can see here, total increase in our budget, 3.1% in the 3rd column from the right. VMERS portion of that right around $440,000. So if there are no questions on the budget, wanted to move on to performance. We had another very good fiscal year ending June 30th. 1-year return at that point was 10.71%. You can see we're above the assumed rate of return for the 1-year, 3-year, 5-year, 10-year, 15-year periods. Very strong performance driven largely by our investments in private equity. Private equity, for the second year in a row, we were acknowledged as the #1 public fund in the country for the 10-year period for a private equity program. If you see numbers 2 through 10 are bunched pretty closely between 16 and 17%. We're well above that at 18.82%. We didn't make the list for largest investors in private equity on the right-hand side, but we think in this case, our small size helps us generate these returns. So very proud of what we've done, not only for the fiscal year, but for the 10-year period. We shared this chart with you a year or so ago. This is the expected volatility in the ADEC as we get closer and closer to the end of that 2038 fixed amortization period. Tim and his team are working with Siegel to resolve this. We are happy to assist in any way as you work through that process.
Eric, if I could just jump in on that. This
sure,
is one that is this one that's going to affect the other two systems a little bit more discreetly, because we calculate an ADEC payment for this system every year, as you know, and we present that to you when we do the valuations. However, the payments that are made are the stated rates in statute and as set by the board for employer and employee. So while the ADEC may bounce around more for VMERS, you know, the funding implications are less dire. On the other two systems, we fund the amount of the ADEC. So the bulk of the work is going to be sort of more targeted at those systems. That the result will likely impact VMERS, but more on an informational basis, less on an actual funding basis, if that makes sense.
Thanks, Tim. So as we think about putting the portfolio together, I know we've talked about this before, but I think it's a useful reminder. Our goal is not explicitly to beat the assumed rate of return. We're not using that as a return target. What we're doing with the portfolio is seeking to maximize returns with prudent levels of risk and liquidity. Those two, the second and third piece of that are very important. If we were just looking to maximize returns, you can see here on this chart expected returns on the vertical axis, expected risk on the horizontal axis. We'd simply pick the highest returning asset classes, in this case, private equity, emerging market equity, and put the whole portfolio in there. Unfortunately, that would bring with it an unacceptable level of volatility, with risk approaching 25% to the far right here. So instead, we're seeking to balance all of these asset classes to maximize returns with prudent levels of risk and liquidity. The liquidity piece means we need to have enough liquid assets on hand to meet the benefit payments to retirees, as well as capital calls and other current operating obligations, without selling discounted assets. And the volatility piece, or the risk piece, is really a measure of VPIC, commissioner's tolerance for risk. In this case, beauty is in the eye of the beholder. We model a number of efficient frontier, or a number of model portfolios along the efficient frontier, and use them to home in on what's the right point in terms of risk return trade-off with VPIC. So when we put all that together, we have these strategic asset allocation targets. 3 asset classes, essentially: growth assets, public equities, private equity, non-core real estate, private credit. These are the drivers of long-term returns. This is a riskier asset class. It's more volatile. Again, this generates the long-term returns. Downturn hedging, this serves as a buffer in terms of economic dislocations. All of it's invested in core bonds, high-quality investment-grade bonds. And we use it as a source of liquidity to meet obligations when there is trouble in the economy. So if you think back to March of 2020, during the early days of the COVID pandemic, global equity markets had sold off by 30%. This part of the portfolio was up 10%, providing us a significant and ample source of liquidity to get us through that short-term dislocation. And then inflation hedging assets, Treasury inflation protection securities, or TIPS, core real estate, private infrastructure, agriculture, farmland. This is about 11% of the portfolio, and we use it really to hedge inflation over the long run. So I mentioned earlier that we're not designing a portfolio to hit that 7% rate of return. It's a useful number, but it's not our target. In this case, we expect a long-term return of 6.4% with a risk level of 11.2%. We think that's still in the vicinity of the 7, so that we're not concerned about meeting the 7 over time. And as you can see, last fiscal year, we did so handily. But this is how we really put it all together to come up with a portfolio that we think, again, maximizes returns over the long run while maintaining enough liquidity on hand to meet current obligations, all at a risk level that's consistent with the commissioner's appetite for risk. We showed you this chart in the past, and it shows essentially the mix of assets required to get to a 7% return over time. In the mid 90s, it was very easy to get there. Interest rates were higher. You could have 80% of the portfolio in U.S. core bonds, 20% in cash, and still get to a 7% return with a very low risk level, 4.9%. 15 years later, things changing. Now you need to have non-U.S. equity, large cap equity in the portfolio to get to that 7%, and the equity portion ramping up that risk now to 9.9%. In 2022, you're forced to have private equity and real estate illiquid assets brought into it. We do have illiquid assets in the portfolio, well over a fourth of the portfolio targeted to illiquid assets, and we invest in them because we believe they generate an illiquidity premium, and we can show you that shortly. And then today, in 2025, again, interest rates rising back up a bit, lowering that risk level from 16.8 just a few years ago down to 10.9% now, but still with significant commitments to private equity, real estate, and other illiquid assets. So this chart shows our illiquid asset program, and the green bars are the returns generated by private equity and private credit, and the blue bars show returns available had we invested those dollars in liquid similar assets, whether public equities or public bonds. And you can see significant outperformance every year for the last 6 years. This shows the inception to date return for our program. So at 2024, you can see from the time we started investing in this significant outperformance net of all fees due to the illiquidity in the portfolio. Again, these assets are locked up for 10, maybe 15 years in some cases. We expect to be paid more for them than what's available, than the returns that are available in the public markets. I wanted to touch on our engagement program. We call it governance. We have the stewardship committee. The intent of this is really to engage with the companies in which we invest. We vote our proxies. We use our proxies to make sure that the management teams and the boards of directors of these companies in which we invest are doing what they can to address risks out there in the environment. We have focused in on environmental, social, and government risks, and you can see ESG throughout our presentations, and we talk about the global energy transition. So there are a lot of environmental, social, and governance themes throughout our portfolio. We think these are important themes not because they're good for society or good for the environment. We think they're important themes because they present significant investment risks and significant investment opportunities. So if you think about climate change and warming oceans and fossil fuel emissions, those things impact many companies negatively. If you think about real estate in Miami, significant implications for real estate in Miami, insurance providers, companies that have a high demand for electricity. We want them to make sure that they have sufficient supply of electricity despite an aging and weakening grid, despite challenges to renewable energies, especially recently, as we've seen with this new administration. So we continue to focus on voting our proxies, engaging with these companies to make sure they're doing what they can to address these risks. Again, these are significant risks. We have a long list of success stories that relate to things like diversity on boards. So we're not telling boards to have a diverse makeup. We're telling them we think they should consider a diverse slate of candidates. Pick the best candidate from the list, but we think if you're not considering a diverse slate of candidates, you're missing potential talent. You're at risk for groupthink. Flaring of methane in the Bakken region. We've had significant success in getting companies to reduce flaring of methane, energy companies to reduce flaring of methane. Not only are they releasing it into the atmosphere, but they're capturing it now, and they can sell it off as another profitable line of business. They've incentivized their corporate management teams to do so. They put measurable metrics in place. So we're convinced that they're serious about it. The management teams don't get paid unless they see real progress. Over the last several legislative sessions, we've been talking about proposals to divest of fossil fuels. We've been opposed to that for a number of reasons. The research that we've found indicates to us that not only if you sell off the shares in those companies, do you give up your say in how those companies are run, but you also, unfortunately, incentivize them to become more short-term focused and to emit even more fossil fuels because you're raising their cost of capital by potentially lowering their share price. So 2 years ago, we engaged Makita to do a study with us to think about how should we think about decarbonizing our portfolio and what else should we be thinking about. Option one was do nothing. We pretty quickly took that off the table. Option two was simply sell off all the fossil fuel companies. We took that off the table pretty quickly for the reasons I just described. Option three was begin to decarbonize the VPIC portfolio. We're doing that. You'll see that laid out in our plan here. And option four was begin to work hard to decarbonize the global economy. We're beginning to do that as well. And you can see in our plan here, we've not come out and said we're going to be carbon neutral by 2050 like many have done. A couple of reasons for that. Number one is we think setting a date of 25 years in the future lets companies off the hook. Number two, we don't know enough about what technologies will be available 5 years from now, let alone 25 years from now. So we're monitoring development of technologies to minimize carbon emissions and to decarbonize the portfolio and the global economy. And we'll be working with companies to make sure they're incorporating those technologies into their business practices as they move forward. So this plan lays out what we're thinking about through 2027 at this point. But I want to just kind of wrap up on a couple of points here. Fiduciary duty at the end. Again, this is not about improving the environment or improving worker safety or promoting diversity. This is about maximizing returns. We think these things all present significant investment risks and opportunities. And we think not only should the companies in which we invest be addressing them, we think we should be considering them in our portfolio. And we're doing so by investing in things like renewable infrastructure. In our private equity and venture capital programs, we have emerging technologies to help companies reduce their carbon emissions. Again, voting our proxies to assure that boards are considering diverse slates of candidates. I'll take this down and kind of wrap up for now by talking about a subpoena that we received from the House Judiciary Committee a year or so ago that accused us of conspiring with 130 other investors, institutional investors that they termed the climate cartel, and that we were conspiring to keep fossil fuels in the ground. They gave us a number of questions and asked us for a response. And our response to those questions was very easy. It was really just a rehashing of everything we've done. From the beginning of our engagement programs, we've been very clear to tie all of this back to generating returns, maximizing long-term returns, maximizing the valuations, profitability, market share, et cetera, of the companies in which we invest. This is not about environmental goodness. This is really ultimately about returns for us. Certainly there are desirable side effects that we see as we reduce, again, flaring of methane in the Bakken, discrimination in boardrooms, et cetera. There's a long list of things that we get from this program in addition to higher returns. But that's really how we think about it. I'm happy to take any questions on anything. I know I've covered a lot of ground. Again, I appreciate the opportunity to interface with you all regularly.
Any questions from the board members out there? John, go ahead.
Thanks, Eric. That was great presentation. Really appreciated learning more about VPIC. I was curious about that target asset allocation slide that you had up and was curious, like, how frequently do you reevaluate that breakout?
So we evaluate it every year. Every year we do an asset allocation study. Every third year we do an asset liability study. So an asset liability study goes all the way back to the actuarial evaluations, the demographics of each plan, the cash flows of each plan, and incorporates that into our risk factor model. We then run what we call a mean variance optimizer. We take every single asset class, assign it an expected return, an expected risk level, and expected correlations with other asset class levels or with other asset classes. We then back test that to make sure our assumptions are reasonable based on what we thought would happen a year ago and what's happened in the year since. Then we run Monte Carlos to help the board understand what does a normal distribution of returns for each portfolio look like. And we do that at different points along the risk frontier. So some are low risk, lower return, others are high risk, higher return. And it helps the board understand how are we thinking about balancing, again, maximizing long-term returns with prudent levels of risk and liquidity. Those asset allocation studies seek to reaffirm the asset allocation targets that we have in place. When we did this exercise back in 2018, when I first came on board, there was a pretty significant restructuring of the portfolio. We indexed a lot of our public market exposure. We fired a lot of active equity managers that just weren't adding value given their high fee levels. We terminated our hedge fund program, some of it because we didn't understand it, some of it because the fees were simply too high for the returns we were getting. Since that time, we've seen smaller and smaller changes in the strategic asset allocation targets, and that's what you would expect as we kind of stabilize around the targets that we have in place. When we did our last study last year, we didn't make any change to the target allocation. We think it's settled in kind of where it needs to be given the current demographics of the three plans. If there was a significant change in any of the demographics of the plans or a significant shock to the economy that we think might be long-term, you can bet we'd be looking at those strategic asset allocation studies more frequently than scheduled. There's nothing written in stone that says we have to wait till winter to run the study. We're kicking that off shortly here, and we'll be looking at results through the winter and into the spring. But there's nothing to say we couldn't expedite that.
Great, thank you.
So one of the guiding principles that we have in the portfolio that I don't think we've listed here is that we want to understand everything that's in the portfolio. We want to understand how it fits together into a program, and we want the board to understand when they're going to like it and when they're not going to like it. We know we're not always going to get it right. We know there will be times when we're below 7%. We know there will be years when we may even be below 0, but we shouldn't be surprised by it. And I think we're at that point with the portfolio. When I talked about the restructuring that we did in 19, one of the products that we took out of the fund was a highly levered hedge fund. That fund had been doing really well, and we understood why it was doing well because it was essentially a levered bet on the S&P 500, but we didn't understand how the individual holdings fit together into a strategy, and we didn't understand what their plans were in the event that equity indexes started to fall, and we were concerned about significant losses. So we terminated that in mid-19. In that COVID sell-off in March of 2020 that I mentioned, that product went to 0. Almost wiped out the Blue Cross Vermont endowment because, again, it was a highly levered bet against the S&P. S&P sold off. Multiply that loss by 4 times of leverage, and pretty soon you're out of money. So we avoided that loss, not because we thought it was going to go to 0, but because we didn't understand how it fit together into the program. And we knew there would be times when it would be way too volatile for what we were expecting it to do.
So before you leave that slide, Eric, you've touched on this a couple of times, and I think I'm just missing the point. We had this kind of negotiated dance with the other systems to come up with that 7% target a few years ago now, I think. Why, when we look at that expected return of 6.4, just kind of dumb it down for me, why that's okay?
So there are a number of reasons, and so the consultants will say, well, there's alpha that you're gonna do better than the indexes because of your program, and we've seen that happening, especially in the illiquid portion of the portfolio. By being small, we are able to take advantage of investment opportunities that other larger players might not be able to. So, for example, there is a private equity secondaries fund run by Cambridge Associates. It's their first institutional fund. They have a long track record that we were able to convince ourselves they know what they're doing. But they were only raising $100 million, and they were looking for an anchor investor to go in for 10% of that fund. And for that anchor investor, they would get their fee cut in half. So in this case, we were able to take $10 million of Cambridge secondary fund at a 50% fee reduction. That's just too small of an opportunity for those big players that you saw on the right-hand side of the page to waste their time on. So that's not reason number one. We think there's some room there to add value. Reason number two is that these things are measured at a point in time. That 6.4% is based on our capital market assumptions at essentially the end of last year. Those capital market assumptions can change significantly from year to year. If you go back to the depths of COVID, those capital market assumptions were giving us an expected return of less than 6, more like 5.6%. We didn't panic and we didn't rush out to lower it. We talked a lot about what's the confidence level that we would meet a 7% return during that time period. And at that point, it was like 40%. So we were watching it very closely. Markets changed pretty quickly. There was a lot of volatility. A year later, our capital market assumptions were indicating a number more like 6.5%. So a significant increase in that expected return based on really short-term market factors. So we try to think about those short-term market factors in terms of long-term trends. And if we were to see, for example, when we were at that 5.5% or 5.6%, that number continuing to stay there or trending lower, I think that would have given us cause to further investigate that. And then number three is that now that VPIC is tasked with setting the assumed rate of return, along with the inflation assumption and the smoothing method, we take it very seriously. We have a formal process in place. We have our own actuary. That actuary looks at our asset allocation model. It looks at our performance reports. It looks at the valuations of the plans and opines on whether that 7% is reasonable. Right now, the likelihood of hitting that 7% is just under 50%. We think that's still in the range of reasonableness, but we do take it very seriously, and we affirmatively act on it every year. Every summer, the actuaries run an analysis. They come to our spring meeting to present initial thoughts on it, but there's a formal process in place where our actuary, and it's different than the plans actuary, we use GRS. GRS does work closely with Siegel on it, but we're specifically affirming, do we still feel comfortable with the 7% assumed rate of return? Do we still feel comfortable with the inflation assumption as well as the smoothing method? And the other thing I would add is that it's just bad practice to be moving that discount rate around a lot from year to year. There's a whole element of budgetary stability and predictability from the administration standpoint that we don't want to jeopardize the administration's ability to fund the ADAC just to have what we think might be a more time-specific discount rate on the plan. So it takes a pretty good reason to move that discount rate. We did move it down from 7.5 to 7 back in, I want to say 2018 or 2019 maybe. That took a lot more effort because all three plans had to approve it separately before VPIC did. That's no longer the case. VPIC approves it. And again, we have a process in place to think about it and set it.
Sounds good.
If I could just add on to that with a couple things I want to remind you of from the risk assessment. To Eric's point, when we move that when we move the rate of return down by 50 basis points, this is that slide that shows attribution of our unfunded liability from various sources, and you see this yellow bar right here, how significant an impact that had, right? So that's supports Eric's point that, you know, you don't want to move these around unless you have to, and you want to be looking long term when you do. The other point I wanted to just show from this is that there is some, you know, the way in which you look at your assumed rate of return, the assumptions that you're using in crafting it can be different. And I think, Eric, when you're doing it, do you use RBK's capital market assumptions?
We do.
Yeah, I think when Siegel used another source, which is the Horizon capital market assumptions, and did it for the risk assessment, they came up with 50% rate of return at 7.3%. So our actuaries are always going to do a reasonableness check because they have to, as part of their valuations and other work they're doing, they have to make sure that whatever inputs we give them, they find to be reasonable. So I think I wanted to share these notes to say that, you know, the notwithstanding the 6.4 that's in Eric's slide, there's a lot of work being done from both entities here to look at this number. And I think I can't sort of agree more with Eric's point that changing that number, you know, it set off 2 years of pension reform for the state and teacher system, given the increases in the ADEC and the unfunded levels. It has big outsized consequences. So you want to always make sure you're in that reasonable space, as Eric said, but you know, not change it on, you know, just because of a short-term impact. So just a couple more data points on that subject.
Yeah, and as a relatively new board member, when we went through that process and changed it from 7.5 to 7, the process itself was pretty weird. Like, that's how we were doing it, and it's great that it's now firmly in VPIC's hands rather than how we had it before.
I honestly think that's one of our best reforms from the, you know, this whole past year. I think it makes a lot of sense to have that. I remember as a lawyer for that, the whole 4-body meeting just was kind of crazy. You know, what happens when people disagree, when different boards disagree and commissions, it was too much. So I think this is much more expert driven, and I appreciate it.
Mm-hmm.
And I
have
think
one other question. I
just,
don't know. Oh, go ahead, Kim.
I was just going to add to that. While we sit as representatives to VPIC on that body, we have a fiduciary responsibility sitting on that body. And so the conflict that could become personal in not wanting to tip contributions or otherwise, things that are not directly related to the fiduciary responsibility of setting those as an independent body. I think while we all come with experience and perspective that reflects the bodies we're coming from, we have a very clear responsibility as we sit there, and so pieces of that go on the shelf, and we can do the rate setting that is appropriate for the information we have, somewhat unconstrained, if you will, by what might otherwise feel politicized potentially.
So one other question, I don't know if this is a Tim or an Eric question, and I'll start by saying I know how silly it is to try to talk about predicting where the legislature is going to go. A few years ago, there was during one of the decarbonization pushes, there was some specific concern around the private equity investments that we have related to that, and kind of a fear that we were going to have to pull out of that sector entirely. And I'm just wondering if folks are thinking that we're going to have to play defense on that again this session. Tim, I don't know.
We have reached out. So the group that was driving most of that is a group called Third Act Vermont, and they have a fossil fuels divestment division whose sole purpose is to have everybody divest of fossil fuels. We have reached out to that group, spent a lot of time with them, explaining our thinking, sharing our research with them, and offering to engage them and include them in what we're doing. So They sit in on our stewardship meetings. They've reviewed our sustainability roadmap that I shared with you. They have to date agreed not to proceed with further legislation. I think, we've all been through what was a very difficult, contentious process over this and very emotional among many on the committees. And when they finally killed it the last time in the House Government Operations Committee, they went around the table, the legislators did, and just about every one of them said, this started off as a really good idea and something that we wish we could do. But it gets really complicated when you start thinking about, are you doing this to punish the energy companies? And what are you giving up in order to do that? And you're focusing on private equity is critical, and I think it's very important in that debate, because once we lose the ability to invest in fossil fuels, we don't have the ability typically to dictate terms to these private equity funds that we're investing in. Most of them will never invest in fossil fuel companies, but if we come in with the prohibition of doing so, they likely won't let us in, because there could be an investment opportunity at some point in the future that's so compelling that has to do with a fossil fuel company, and that they need to participate in it. Our role at that point would be to make sure it's being managed responsibly and that they're transitioning it from a bad company to a good company. So I think back to your original question, my sense is it's faded a bit. I think we're focused more at this. Certainly, we're focused more at this point on post-retirement healthcare benefit plans and potentially bringing those over to VPIC. There's almost $400 million in assets set aside for teachers and employee post-retirement healthcare. Treasurer's office has reached out to us to increase our involvement in the management of those assets. We just signed a memorandum of agreement with that office, increasing the level of our level of input into that process, with the expectation that by involving VPIC and transferring those assets over to VPIC oversight, we can exercise a higher level of oversight on those assets, more institutional quality risk management processes, integration into our asset liability study and asset allocation study processes, potentially more diversification within this program. So we think there's a lot of reasons to move those assets to VPIC, and my sense at this point is that's what what people are talking about at this point as we come up on the session. But Tim, if you're hearing anything different, be interesting to hear.
No, I'm not hearing anything different. The only caveat I put on what Eric just said, I do think the tides have kind of moved away from it. We are going to be taking two issues to the legislature this year. The one is what Eric talked about moving the responsibility for investment of OPEB funds from our office to VPIC. The second is looking at our funding policy and that amortization time period. The only thing that I always worry about is when we bring topics to the legislature and we have a bill that talks about these things, we do need to be ready to play some defense, because that's when folks can, see a vehicle for an idea. And so we're certainly going to be looking out for that. And really, frankly, anything else, we're going to try and keep these issues very tightly packaged and constrained. We've been doing a lot of work with stakeholders already to try and let them know what's coming and make sure that, we're all on the same page. So that's the only caveat I put to it, is that whenever you go there, there's sort of you never know what you're going to come out with.
Every bill can turn into a Christmas tree.
Yes. Very much so. I feel like there was one, I remember hearing a story about, I think, an effort to a bill that ended up maybe closing a pension plan. I think it was in a state down south. It was a solid waste bill, I think. And it was, they ended up just looking for a vehicle at the end of the day to attach something wholly irrelevant. That's always thinking of that as the cautionary tale. So.
Great. Board members, any other questions for Eric? All right.
Okay, I
Thank
just
you
made
all.
one-
Really appreciate the opportunity to interact with you and keep you in the loop. Thank you.
Eric, before you leave, I did just want to remind board members that, this board recently appointed Chris Doobie again as alternate. And he had mentioned that, he's happy to serve, but also that should others want to along the way, that is an opportunity out there to serve as an alternate on VPEC. So I just wanted to remind them because Chris was he made sure to emphasize that to me a number of times. So that invitation remains out there from Chris if this is an area that folks might want to look at further.
Okay, thank you.
Thank you.
Take care.
All right, and I think we're sticking with you, Tim, on the investment policy.
Yeah, so keeping the theme of investments, this is an issue that you'll recall we talked last month about. It was our the investment policy statement we made for the VMERS DC plan in collaboration with RVK. We wanted to give folks a month to kind of look at it twice, and if anyone had any thoughts about it, haven't heard of any. So from our perspective, we would recommend that the board adopt this policy as a point of information. The other two boards, the state and the teachers, have adopted similar investment policy statements for the plans that they oversee. And so we're happy to answer any questions about it, but also would recommend a motion to approve the IPS and watchlist policy.
Would anybody like to make a motion to approve of the policy? Kim, is there a second? Second from John. Okay, any discussion on that motion or on the underlying policy? I did a quick look at what you sent today, and it looks like nothing's changed from what you sent out a month ago. Okay. Any questions from board members on that? Seeing none, all those in favor, please say aye.
Aye.
Aye. And motion passes. Delta Dental.
Great. So for this one, we included a few items in your packet. I think the most important one that I'm going to share for right now, because this is the only thing that's really changing, is the rate history for this for the dental insurance. So by way of background, our office procures a dental insurance policy for all of the retirement system retirees. This policy is not subsidized for any members in any system. And so it's basically, if the member is interested, they have a one-time opportunity to elect at the time they retire, and then they can maintain this policy throughout their retirement. We have been on a really good run. There were since I think 2020, rates have been held flat for this product. We did an RFP back in 23, you'll see. And so on our current contract, we have a couple more years, 2 more years available to extend. However, when we started these discussions with Delta Dental this summer, after they did their actuarial review, you can see that they saw an actuarial need of an 8.86% increase. They initially proposed to us a 6.5% increase with a 6.5% cap next year. We spent about a month negotiating with them. We were able to work it down slightly to a 5.4% increase with a 7% cap next year. Assuming the full cap is needed in both scenarios, that works out slightly more favorable. So we appreciate Delta Dental's willingness to negotiate with us on this, and so we recommend moving forward with this 2-year extension. And I'm happy to answer any questions about it. I have a actually rather lengthy motion that I propose to all the boards for consideration once you're ready, but happy to answer any questions.
Any questions from board members? Kim?
I think I'm just curious, do they offer any insight into anticipated increases moving forward, in that this has held steady for so long and this might otherwise, good that they worked with us on it. But if that were a year over year every time, probably be
Oh, yeah.
more challenging.
The only thing that we talked about really was that they are, I think with the inflationary environment we're seeing with everything, we struck this agreement for this last hold for 1/1/23, kind of before a lot of the inflation, was coming in and sticking. We were negotiating this in 2022 during an RFP. So my understanding from conversations with them is that this is just sort of environmental, like the nature of everything increasing. And what, the point they made, which I think is a good one, is they don't want EC from back in 20, we had the almost 12% increase. We don't want those. So the idea of kind of putting in an increase when you need it instead of kind of going for as many holds as you can makes sense. 7% caps doesn't mean that we're going to get there. And then following that, we will do an RFP. I'll caution this board, as I'm sure folks might know from their other day jobs, there's not a lot of games in town here for dental insurance. So we do the process because it's important that we do the process. But if I recall last time, I think maybe, I'm not even sure we got another bidder. So, we'll see if there's anything out there in a couple of years if we move forward with this contract. That's all I really have on that. Yeah.
Any other questions from board members? All right, so Tim, why don't you lead us through the motions you need, or Justin?
This is one that requires approval of all three boards. So we always try and have the same motion presented. So the recommended motion would be to authorize the chair to execute a contract on behalf of VMERS with Delta Dental for dental insurance coverage in 2026 and 2027, with a 5.4% increase in 2026 rates and a cap of 7% increase in 2027 rates, subject to review and approval by legal counsel and state agencies required to provide relevant contract authorizations.
Who would like to make that motion?
So moved.
See John, and then second by Kim. Any other discussion on that? Seeing none, all those in favor, please say aye.
Aye.
Aye, motion carries. Need anything else on that, or is that good, Tim?
No, that's good. And we'll get you, once we get everything drafted, sent around. It's really going to be a short one. We'll get it around for your DocuSign approval, Morgan.
Sounds good. All right, any other business to come before the board? Tim, Justin, Bill, anything from you guys?
My only reminder is in person in November. Looking forward to seeing folks up here, hopefully, if you can make it. I think Bill will be sending around some information in the coming days, weeks. But we're really excited to have that meeting up here again. And I think this time you guys will be on the same day as the VSTRS, so we'll be able to have kind of a joint lunch, sort of at the end of one, beginning of the other. So hopefully you guys can come meet some of your colleagues on the teachers board.
And lunch is at noon, and then our meeting is after lunch, correct?
Yeah, I believe so. I think teachers is the morning, and then VMERS is the 1 o'clock afternoon. So yeah, if you come, it's great if you would come, for noon to, you'll get a lunch out of it and to hang out with some actuaries and other really exciting folks. Throw a lawyer in there for you.
Okay, any other business or any other announcements from folks? Seeing none, I will entertain a motion to adjourn. And that's going to be by Will, seconded by Kim. All those in favor, please say aye. Aye. And we are adjourned. See you folks, hopefully in person on November 12th.
Thank you.
I
Take care, folks.
See you. Thanks.